Hello and welcome to the Defining Your Niche podcast, where we explore alternative asset classes within commercial real estate. Still getting used to the new name. This used to be the Self-Storage Made Simple podcast, but we've broadened our horizons. So we're digging into small bay flex as well. Still going to see a lot of people heavily involved in self-storage on the podcast. And with that, very excited to welcome Cody Baker to the podcast. Cody, thanks so much for coming and sharing some time with me.
Yeah, thanks for having me, Thad. I appreciate being here.
Was awesome, and it's one of the things I absolutely love about self-storage is that people within in the industry are just a really special group of people. We were introduced by Tyler Sellers, who not only is a self-storage investor, but the CEO of Cactus, a really cool AI company that's coming in and helping investors with underwriting. Love that aspect of the industry, and it is such a unique asset class. I always start the podcast off the same way. I don't think unless you were born into storage, anyone ever sets out and, they're in sixth grade and they're like, hey, I'm going to be a storage person when I grow up. I love to see the story of how people got into this asset. So how did Cody Baker find himself involved in self-storage?
Yeah, so I'm a debt broker, for lack of better terms, right? I help clients, investors source proper financing for the project, whether it be ground up construction, stabilized stuff across multiple different asset classes. I actually got started, this was back in 2020 now, 5 years ago, in multifamily, because the firm that I joined had primarily only done multifamily. And then after I'd kind of, as a newbie in the business, had built my little list of investors and was working that list, I was asked to hand it all over and start the industrial division of that company. And so through industrial, the very first deal I did was for a guy that owned 18 storage properties, but I was helping him buy a asphalt business. So completely unrelated, but this was my first go into industrial. And through talking with that guy and getting his deal done, I just started picking his brain about self-storage. The next deal that hit my desk was a self-storage deal. And then once I marketed that, the next deal that hit my desk was a storage deal. So it just started snowballing. And so I like to say that I didn't find storage found me. And now I'm just letting go. I'm invested in 650,000 square feet of storage. My wife and I have a small facility about an hour from our house that we self-manage. And I've now to date financed just over 350 million of commercial real estate, and almost 200 million of that is self-storage. So it's about 60% of my total production in self-storage.
I'm fascinated by this on multiple levels. Relatively new to the side of this industry overall, but you've been in it in a very interesting 5-year segment, right? Like the difference between 2020, 2021, 2022, you start laughing already because there's questions going.
Oh, yeah.
And I'd love to dig in on that a little bit, right? As somebody we're in the middle of a due diligence process on a ground up development project right now. Mm-hmm. Looks drastically different than what it looked like 2, 3, 4 years ago.
I can imagine.
Yeah. Tell me a little bit about what you're seeing in the industry versus when you started in 2020, 2021, and what it's like trying to find, forget about the equity piece for now. We can dig into that a little bit, but especially debt, whether it's traditional bank financing or some type of alternative lending, how much different it is now versus what it was when you first started in the industry.
Yeah. So, the different types of loan products that I can do are, between local, national, regional banks, credit unions, life companies, debt funds, private institutions, hedge funds, family offices, CMBS, I'm missing some, but you name it, I've gotten access to it. And so all those different products kind of function differently. However, when I got into the business, 2020, it was the Wild Wild West. I mean, interest rates were still low, even though COVID was just hitting. Nothing had really caught up yet. And so then, come 2021 was my first full year of production, essentially. And I did 70 million in production my very first year, after
Whew.
being trained up and starting to close deals and get my name out there. I did 70 million that first year, which is great. Um, did 65 million the next year, and like the interest rates rising didn't really affect us at first.
Yep.
Really, like things kind of have a delayed fuse in the business, but I watched it. I watched Prime go from 3.25 to eight, 8.5.
Yep.
So and I had a really good mentor at the beginning of my career in this business who had gone through the 2008, 2007, 2008, and then the trickle effect after that of 9, 10, 11, and then things started picking back up in 12 and 13, and it was gangbusters.
Yep.
It's kind of like where I came into the business, where it was gangbusters, and then I kind of saw the fall, and then now we're seeing the rise back up a little bit. So the landscape is widely different now than it was when I started, largely due to the appetites and the credit policies of these banks and credit unions and all these different firms, as what happens is when they see a recession and they see something happen in the marketplace, and then loans go bad for whatever particular reason, they start adjusting policies internally to protect against that.
Yep.
And so people going out and getting a loan now, there might be 5, 10 additional policies for, bank one versus bank two versus bank three, and so on. That it just makes the shopping process uh, a bear. It's, I went from, just to give context to this, I went from, you send me a deal and I could make 15 phone calls and have 3 to 5 term sheets by the end of the week.
Yep.
If you called me on a Monday,
Yep.
right? Now I've got deals where, I go out and I shop the first batch. Like I don't like to just spam out deals to lenders.
Yep.
So I'll go out to the first batch of 10. If I don't see what I'm seeing, what I'm looking for, I'll go out to the next batch of 10. And then I'll go to the next batch of 10. And so the shopping process is a little bit elongated. But I've got deals where I'm out to 70, 80. I've got deals where I was out to 130 plus lenders.
Wow.
Find, the two term sheets. So we went from like a, 30 to 40% conversion ratio from outreach to term sheet
Yep.
to 2 to 3%.
Yep.
So it's just it makes, and I hate to say it this way, but in down markets and downturns like this where things tighten up, and it makes it more difficult, it makes guys like me a little more valuable. And
Yep.
so I really didn't see a dip in production per se. The job just got harder.
Yep. I love that. It's so interesting. I spent '08 running a martial arts school. That was my previous career, and have a couple of my students who still run martial arts schools, and I used to preach that to myself during the '08, '09, '10. Hey, you're going to have to work harder for less money, but
Yep.
or maybe the same money, but work harder to earn it. And but on the flip, on the other side of that is going to be a reward. And my friends who run schools now, when COVID shut everyone down, they had to work so much harder to keep their school open. But when things reopened and all their competitors went out of business,
Yep.
the martial arts, Tiger Showman's the franchise that I ran up here in the Northeast. Um, they've never been more successful than the last 2 years
Mm-hmm.
because they survived that struggle. So I guess it's a long-winded way of saying, maybe not the worst thing
It's
because you kind of separate the wheat from the chaff, right?
exactly those. It gets the non-players out of the way
Yeah.
and let the players play. And I think that's true not only for the brokerage side of the business, but you can weather the storm. You gain clients during that storm because other people are dropping off. Those are
Mhm.
clients you can hold on to for years. I mean, my
Yeah.
average, I wouldn't say average, but I don't know how to calculate that, but I'd say 90% of the clients that I work with, I've been doing deals with for 4 or 5 years.
Right. Yeah.
Uh, but that's one thing that I was taught very early on is if you can weather that storm, you come out on the other end and you can snag a lot of business. And I think that's true for the investor side of things too. When you're going in competing, putting in offers, if you can weather the storm, continue to hit your numbers of like how many deals am I underwriting a week versus putting in LOIs and the conversion rate gets smaller. Sure, it's more work to find the deals, but if you can weather through that, you build relationships with the brokers, you build relationships with partners, you build relationships with lenders, you come out the other side, and when things start picking up, I mean, your pipeline can blow up.
I love that concept, right? And I was just talking about that this morning. For us, right, we didn't buy a project in 2024, ground up development or existing, and we'll buy both in storage and in small bay flex. But we did track. We do know how many LOIs we were sending out, and we do know how many deals we were underwriting, and we know that we were doing the underlying work that needed to get done. It just was an environment in the market where we didn't have a deal that we were willing to push our envelope to close on, and so we kind of had to, if on the other hand we weren't tracking and we didn't know how many deals we were looking at, and we didn't know how many deals we were underwriting and how many LOIs we were sending, how do you finish the year and know that you're still doing the right thing? And I think you touched on something that I believe in wholeheartedly, which is the market knows the work you're doing,
Yeah,
and people ultimately respond to that work, right? And that you can't fake it with, in our instance, sellers, in your instance, investors looking to find capital. You can't fake your ability to go do what it is you need to do for somebody, which is a concept that I love, right? The work ultimately is the whole thing.
that's right. That's right. Yeah, no, we've done a good job. I think of advising clients through some of the storm, and this year's been the what's the way to say this? Like the for lack of better terms, it's the bloodiest year that I've seen.
Yep.
With blood in the water, with loans that have gone bad, with floating rate interest that's whew.
Somebody got into a project in 21, 22, underwriting a deal where they think they're going to get 5, 6% construction interest, and all of a sudden they're at 10 and a half, 11.
Yeah,
That pencils very differently.
it's very difficult to get out of those deals.
Mm-hmm.
Um, I've just in the last probably 4 months, I've saved a few clients out of deals. Other clients are um, separating from partnerships, and that's a whole nother scenario where the loan sizing is kind of similar, but it's just a different purpose of why they need to get out of the loan.
Mm-hmm.
Um, and so I think through these downturns, another thing is your reputation and your relationships with partners and upholding those. And, sometimes those can, in down markets where you have properties that are hurting, it really starts to um, bring out who people are in a partnership, if that makes sense.
100% agree with that, and something I discovered late in life, that aligning with somebody in their values is maybe the most important key to long-term success of, especially in a partnership, but any business relationship, right? It not just somebody you're working together with in a business, but who you're doing business with. Um, I wish I'd known that a little younger,
Yeah,
but you start to, and you really recognize that when things get tough, right? Because when it comes time to put some food on the table, values get challenged,
yeah,
right? And so you start to see who's who, and what they're gonna stand by in those tough times.
yeah. And I think I saw something the other day that I think it was yesterday on LinkedIn uh, that, and this is kind of true across the board, that where you find additional questions to ask. This post that I saw was about it was, I think it was a advisor, they advised GPs and LPs, and it was like, what other? No, it was the CEO of GREA actually posted this,
Okay.
talking about additional questions that you ask GPs if you're coming on as an LP.
Mm-hmm.
And what do you do? How does the GP operate? Are you still taking asset management fees if the property's not performing? You
Mm-hmm.
know, things like that. That was one specific question they asked. I thought that was really good.
Yep.
But
Big
I
big
think
question right now, right? Because a lot of, we know what's happened in the general market with rates, with leasing rates, with the ECRI policies and the REITs all jumping on. But I just looked at a 10 by 10 in a $25 market, in Greater Philadelphia. They're leasing up a facility $52 for a 10 by 10 rate. For those you don't understand, that's like $7, $6 a year per square foot on that facility that should be getting 25. And when you underwrote the deal, you were expecting to get 15, 18 at a minimum.
Mm-hmm.
You're not performing up to pro forma right now in a lot of instances. So those questions become wildly important. Are the LPs going to be looked after in that way?
Yeah. And my point of mentioning that is like that's what happens in downturns, right? When you start to see blood in the water, like people are hurting and they start asking questions because of that hurt, and then other people learn from that, right?
Yeah.
The same is true, and just to wrap this back around to lending, the same is true for the lenders, and their credit teams. I mean, they're people as well. They're investors as well. They, have an appetite, and once they see loans go bad, they start asking more questions. So that's just another layer on what makes lending difficult in today's market. The amount of questions that they're asking on the front end,
I
like
was
about
ge-
you're needing to check before they give you a term sheet.
I was going to ask that. You talked about, right, maybe talking to 10 guys and getting 3 term sheets in 2021 into 2022. Now talk to 100 guys, maybe get 2 or 3 term sheets. 100 banks, excuse me, not guys or lending outlets, whether it be life insurance or whoever.
Mhm.
Um, the term sheets are different, right? It's not the same term sheet you
You're
got two,
starting to
three
see
years
term
ago.
sheets now with loan covenants that are going to be in the loan docs,
Yeah,
and they're bringing out covenants on the front end now.
yeah,
But I'm prefacing clients for there where it would have been like a week or two, to get a competitive term sheet on the table. Now it's like but if we have the time, let's try to budget for 2 to 4, because there's a process that I like to now in today's market. I don't like to just get a term sheet from a loan officer. I want that term sheet reviewed, scrubbed, signed off on by the credit committee before we sign it and start spending money on third parties.
yeah,
Sometimes that process is a week. Maybe it took me 2 weeks to find that lender.
yeah.
So that's a whole 3-week process. But now, the approval process, once they get through the formal underwriting, is a breeze. Like I don't really have a concern for it not getting approved, which is a much more comfortable place to be in today's world where there's so much competition on offers. If you hiccup once, they're just going to go to the next offer. So I try to implore a little bit more detailed of a process on the front end, just to add a little bit of protection and comfort for the clients.
I'm interested to pick your brain about this because one of the challenges we found in the last year is that, and we benefited from it. So I'm gonna preface this by saying the headwinds that allowed Safe Storage USA to exit 3 projects incredibly well are preventing us now from being able to enter. And essentially, what that is the big boys, the top owners, are buying more tertiary, smaller
Yep.
facilities than they used to buy. And so, while we benefit as the seller of selling to a top 10 owner we just sold in March of 24, Sturdivant, Wisconsin, we can't buy in that tertiary market so easily anymore because the big boys in there, and quite frankly, they're paying at what for us would be negative leverage. And
Right.
so I'm interested to pick your brain a little bit. Are you seeing banks funding acquisitions of existing facilities where maybe the initial underwriting is not showing positive cash flow on the front end? How are buyers dealing with that and able to still transact?
So there's got to be a good story on, because if you can, obviously, if you're buying a property that's got negative cash flow day one, your pro forma shows it's
Yeah,
got cash flow after the first or second year, right?
we like to think so. That's the hope.
Well, it should be.
100%.
So, and there's got to be a good story for it. If that story is specific to, I'm not going to throw a whole bunch of different variables in here, but maybe the property's already at market rates, and you're projecting pushing rates, or you have to raise rates. Like there's no expansion. It's just like a expense and revenue optimization play. In order to make that work, then the economics of it, the economic vacancy has to be enough to where it's a no-brainer. Like we should be able to raise the rents if it's 40% economically vacant.
Yeah.
then we should be able, the bank's thinking of like, okay, I don't want to have to raise all that 40% in order to make my cash flows at a minimum.
If I can raise 20% and hit my cash flow number.
That's a less risky deal.
Yeah.
Sure, I'll give you the year of IO. Sure, I'll give you, et cetera.
Yeah.
And so it's all about the story from that perspective, for one, and backing it up with data and facts, in which I'm sure you're familiar with Tract IQ. They are trailblazing the data space right now for self storage and adding a whole bunch of data that
I was going to bring that up. Your
a lot of
golf
people
outing
are.
with Noah.
Yeah,
You got you,
Noah's a good buddy of mine. I'm invested in all of his projects.
yeah.
Invested in Tract IQ as well. So the 650,000 square feet that I'm invested in is all with Noah. Noah's a good buddy.
Love it. I was doing my background research and saw you guys out winning some money for charity on the golf course. So
Yeah,
very, very cool.
there's a Kensington Vanguard, KV National title company golf tournament down at Lajitas, which is like the top course in Texas. You got to fly in through JSX, which is like this little private airline.
Nice.
It is a sweet experience. But yeah, I got to partner up with Noah, and him and I actually won our flight and got to donate 10 grand to charity, which is awesome.
So it goes to a whole different side, and I'm going to pick your brain a little bit because you're on the investor side as well as brokering debt and equity. Um, Texas is such a fascinating place, right? It's like a country within a state because there's so much market differential. I mean, I've looked at projects in El Paso and San Antonio and Austin and DFW and Houston in McAllen, Edinburgh. I mean, you're talking about a state where every single market is drastically different with the dynamics that are going on there.
Yeah. Yeah, it's a very interesting landscape, and I get a particularly interesting insight being connected to all these different investors across Texas. I own properties in East Texas. I got clients that own properties in West Texas, and what you'll
Yeah.
find is like I get insights of like collections, which is an interesting data point that you don't really get elsewhere. I have a client that owned in my market in East Texas, and he also owned in El Paso and Amarillo, and so he had. I just had lunch with him a couple weeks ago, and he was like, "Man, like my collections in East Texas is like 25% is we're having to chase every month.
Yeah.
Yeah, West Texas don't have to chase them. I don't even get pinged. I don't even get pinged by the management company that there's a problem. And so you've got the mindsets of the types of people that are in these different markets is widely different as well, which is interesting to me.
I love that, and that's what you have the different. It's such a big state. Anyone that hasn't traveled through Texas, I mean, look, you can drive for hours upon hours and not come across anything that resembles a city. So, but you have different personalities, and you kind of pointed out. The other thing that I find fascinating is the difference in municipalities, right? Like if I go to Houston and I've had a couple development projects that I worked on in Houston where, listen, if you can find a raw piece of land, you can build whatever you want as long as you follow the code versus DFW where like you're not going to go just build something because you want to build it. So I find that fascinating where you're within the same state, but the ground rules from one place to the other can be so drastically different. How important is that for you as a somebody trying to back up debt that you're working with somebody who truly understands the market they're operating in?
That's very important because there's certain pieces that the lender needs in order to end up close the loan, right? And so if you're not familiar, maybe you're used to West Texas county rules versus now you're trying to build in DFW, and you budgeted 3 months for the DD. You're you might run into some issues with that timeline.
Yeah.
So you've got to have some sophistication behind that in order to have the right timing to get all those pieces done. The expansion that we did out in our East Texas property, I mean, I think I stepped into the county office, so this is what we want to do, and they just gave me a stamp. I was like, all right,
Yeah.
thanks.
Yeah.
um, but yeah, I've got clients that are building industrial flex. It's one of the other asset classes that I really really like. Up in North Texas, McKinney up through Prosper and just all those growing areas of North Texas.
Talk about growing area.
Killing it, killing it.
Yeah.
Um, and we have one deal in McKinney that was supposed to close last July. Still haven't closed it. We're still working on it because of the back and forth with the city, the back and forth with the architects, back and forth, et cetera, et cetera. This change, that change.
Yep.
Uh, if the developer's not experienced enough, um, they're getting one change at a time and not asking like what do you need in order to approve this.
Right. Give
Like,
me the list. Let me answer
give
all
me
the
the
questions
list,
at
we
one
gotta
time.
knock it all out,
Yeah.
and it can drag on for months. So that's just one.
You bring up such a fascinating point there because there's that eternal debate. My partners joke at me all the time because they ask me to call existing facilities and I don't. I call raw land because I love ground up development. They're like, we stopped even trying to push you to go after existing facilities. We know it's not your thing. But it's this fascinating thing as a ground up developer where like you want those barrier to entries, you want those challenges but to a point, right? Like there's a point where it becomes like, yeah, I don't want just anybody to be able to come in and open something up down the road. But I'd like to be able to at least put a timeline on paper in my pro forma how long think this is going to take. And it can be, as you said, I mean, it can be so drastically different, and it can be drastically different 3 miles apart, right, from one municipality to the other.
Right. 100%. I would say the amount of development that I do, uh, because like if storage makes up 60%, I'd say probably 30% of that's development.
Yeah.
Or if we make it 50%, some add in expansion into that, and so you're kind of dealing with the same processes. But
Yeah.
um, the other the other 40% of production, I'd say half of that is development across retail, industrial, and small bay flex. So I get
You're
it from
speaking my language now. Tell me why you, and I'm not going to ask, I'm not putting your words in your mouth. What about small bay flex has got you excited? Why do you like that asset class?
I think it's got similar characteristics to it's like a blend between regular industrial and retail, where you kind of have the security of leases, but also the kind of the self storage kind of feel to it, where it's smaller units and they're sectioned out and they're probably only a year long leases. But the biggest thing for me is that the attraction to it from a very wide tenant pool.
Yeah.
uh, I've got clients that are building a small bay flex or luxury warehouse retail, building at the front of the storage property.
Yeah.
And that does really well. And then once that does well, then the rest of it kind of follows.
Yeah.
So you're starting to see this get paired with other asset classes like storage, which I think is smart, and I think it makes sense. But the wide tenant pool that small bay flex can pull in, I mean, you'll have a contractor warehouse next to a dental office. Like it's kind of a weird thing, but it works. It depends on the market that it's in. Like it needs to be in a
Yeah.
market where that makes sense. But uh, yeah, I like the wide tenant pool. It's probably my biggest thing.
We that was certainly attractive to us as we went down this road and as we were discussing things to branch out into. Obviously, it's close enough to storage in terms of the building type. Certainly,
Mm-hmm.
some significant differences. A bathroom in every unit, which is one of the benefits of storage, not having so much plumbing, but that tenant pool was our single biggest draw. It was the ability to draw from, we're building a facility with 35 units in it. And, literally, we're not even trying to guess what clients we're going to have. We have some clients we know we're not going to allow,
Mm-hmm.
but we're not even trying to guess what. Can we know we'll have, tradesmen for sure, but, the BJJ school, gymnastics, you said it, dental office, the people that don't want to pay that top end commercial office or medical office or retail space, that can get away with it, which is what attracted us to it as well. Excited about that. And actually, this I know you signed up to come to our we're having an event on
Yeah.
February 4th. Unfortunately, this is airing February 5th. So if you're watching this, you missed the event, reach out to me. I'll give you a copy of it so you can see it. Bringing in a bunch of people with experience in that space to talk about it. I would be remiss. It's hard to believe that 30 minutes has gone by already, and I try and keep this thing as close to 30 minutes as I can, but I'm going to ask you if you can to stick around for a second, because I would be remiss if I didn't ask you, as somebody who's dealing with banks every day and dealing with lenders, whether it's life insurance or whatever institution, to prognosticate a little bit and give me your take on, as you're having all these conversations. What the we're taping this on the 23rd of January, so the inauguration was 3 days ago. Obviously, a pretty big change in terms of the sense of the administrations that are now running things. Where do you see it going? What is the outlook for 2025 into 2026? Are we sort of coming to the tailwind of this challenging time? Are we still right smack dab in the middle of it? Would love to put on your Nostradamus hat and pick your brain a little bit.
Let me get out my crystal ball. Hold on just a second. I think I put it right. The last time that Trump took office, he was at 4.5% as the federal funds rate, I think, and he left at 2.25.
Yep.
So I think that's a great indication of how he's able to do things that help guys like us.
Yeah.
And what we're looking to do. I think what I don't think it changes is I don't think it changes the policies of the banks. I think they're still going to be asking questions. They're still going to be protecting against the downside of what they've just seen over the last few years.
Yeah.
Now, will the interest rate market change and shift? Sure. But I've been saying this for a year and a half. I think that prime needs to come down. We've got too big of a gap between where sellers think their interest rate is and where the actual interest rate is. So that gap needs to close in order for transaction volume to pick back up. Now, whether that leaves blood in the water with people losing equity in projects, that's not part of this analysis. But the really two big indexes are the treasuries and prime. And so when you had prime at 8.5 and you had the treasuries at 3.5, and then call it a 300 spread from the banks, I mean, that's 7.5 to 8.5, and then maybe they have a half a point on there. I mean, you've got a 1.5 to 2 point spread, and that's a lot of value when you break it down to a purchase price.
Yeah.
So in order for transaction volume to pick back up, which is I think what everybody wants, we need that gap to close, in which where treasuries have kind of been hovering and inching up a little bit, and prime's been coming back down. Now we've really only got a point spread between that. So we've seen in the last 2 months, 3 months, a lot more properties hit the market.
Yeah.
A lot more properties selling. You see brokers posting those just sold.
Just sold.
Just sold post a lot more here in January 25 than you did the last 6 months.
Yeah.
Of 24. So, I think that's a big key to seeing transaction volume tick up. And we've got the right administration in place that understands the real estate world. Our president was a developer in New York. He gets the game.
Yeah.
So, I think the guys that have been sitting on the sidelines getting ready to play are pulling out their checkbooks.
Yeah.
But does that create competition? Sure. Does it make it harder? And the bigger guys going into smaller markets? Sure. I don't think it gets rid of any of these challenges. It goes back to your tenacity. Or I don't know if that's the right word, but back to your
absolutely, tenacity.
Your tenacity and your consistency and your will to make that goal happen.
Yeah.
It's just a numbers game. Will your conversion rates go down? Sure. But you fire enough darts at the board and one's going to stick.
I'm not afraid of competition. I'm afraid of a game that you can't win, right? And you nailed it. When interest rates, when the gap between prime and treasuries is what it was, you can't win the game. Like you just there's not there's not a scenario where you can accrue enough assets at a promise of cash flow, let alone cash flow from the beginning, to make it worth time. And listen, this is what we do. This is our job. This is how we put food on the table. And hopefully, and one of the things I love as somebody who loves ground up development, when you're building a project for 8, 10, 13, 15 months, you're talking about hundreds of people that are skilled labor, that are making a really good wage, that are employed, and we've seen that slow down markedly, and so from
Mhm.
your lips to God's ears, fingers crossed, hoping that we start to see that. And listen, we know life is cyclical, and we're going to go through. There's not going to be the last time we go through a slowdown.
No.
And there'll be an uptick, and it's more a matter of when it happens than if it happens for
Yeah.
sure. But
What I have heard is that we are in, if you take, history repeats itself, right? And
yep,
if you take what happened in 2007, 2008, and then the trickle effect of that lasted through like 2011,
yep,
a couple years, and then the people that bought assets in 2012, 2013 just sold them in 20 and 21
yep,
and made out like bandits.
yeah.
And I've heard that 2025 and 2026 is that 2012 and 2013
Yep.
scenario. So,
Want to be buying right at the right before the break in the curve, right? You want to be down, still a little bit on the downslope, and maybe in the short term it's a little bit painful, but in the long term, that's where the real profit is.
yep, I'm optimistic and hopeful.
I love it. So let me
Pray it
wrap this
lasts.
up by asking this question. Somebody wants to get a hold of Cody Baker. They got projects they're trying to find funding for. What's the best way for someone to get a hold of you? And who's the best person that you want to talk to, as far as market, as far as asset, as far as size of asset? Who's the person you're best positioned to help?
Active investors that are looking to offload the headache of finding good debt and executing on that. I've got clients that have me on retainer and I look after their entire portfolio and identify when there's opportunities to execute on a capital event. I work with a first time investor and guys that own 250 plus properties. So I'm kind of all over the place from that perspective. As far as asset classes go, I specialize in storage and industrial, but I've got a load of car washes and RV parks and mobile home parks and some multifamily deals here and there. So I'm kind of agnostic from that perspective.
Yeah.
Asset class, development, acquisition, refinance, etc. Baker Capital Partners is the name of my firm. My email, I'll say, is CB. My initials, Cody Baker, CB at baker-cp, as in capitalpartners.com. And after seeing, I do a lot of speaking events and stuff with all the different coaches that train on self storage. And I always end up helping them with their deals. And then I train their students on financing. And so I actually put together my own little financing course that you can purchase and learn
Love it.
how I do my job. Really, you should be able to take this course and not even need to hire me. I give you my underwriting models, my presentation models, how I negotiate with lenders, how I find the lenders, most importantly, and how we get deals done. You can go check out the landing page for that.
I'm gonna have it scrolling across the bottom. You don't even need to worry. We'll get that, and we'll have it scrolling across the bottom
Okay.
so people can
It's
figure that out
it's
very
very
easy.
simple. Storagefinancingsecrets.com.
Love it. Storage financing, and I have so much respect for somebody who's not afraid to share what they know. Who understands, and I always believe this, that we said earlier, the work wins in the end, right? So you can share every single
Amen.
thing you know, and if somebody's not willing to do the work, it's not going to matter anyway. So,
Amen.
Cody, been an absolute blast talking to you. So appreciate you coming and spending some time, and look forward to connecting further as we do more deals. We'll certainly reach out and pick your brain, and look forward to seeing where that relationship goes. Thanks so much for joining us.
Same here, Thad. I appreciate it.
That's it for this week's episode of the Defining Your Niche podcast, where we explore alternative asset classes in commercial real estate. We look forward to seeing you guys back next week. Thanks as always to my friends at Proprise. Check them out if you're looking for deal sourcing, unbelievable software. You can find them through the links in the podcast as well as on LinkedIn. We'll see you guys next week.